Before we dive in, this video is for educational purposes only. I'm a peer sharing insights, not your financial advisor. Always consult a professional before making major investment decisions.
Welcome back to another explainer. Today, we're mapping out the ultimate financial playbook for a very specific yet incredibly common dream: retiring in the Philippines at 60 as a dual U.S. Filipino citizen. You know, you've worked hard, you've diligently saved, and now you just want to enjoy those beautiful beaches, the lower cost of living, and a return to your roots. But actually managing two totally different financial lives across the globe, well, that requires a bit more than just booking a one-way flight. So we're going to break down everything from worldwide income taxation to reporting rules and even healthcare. We are taking you straight from the dual citizen's dilemma all the way to becoming a completely confident expat.
Let's kick things off with the million-dollar question, right? It's the one literally every future expat asks, usually secretly hoping for some magical loophole. You might be thinking, hey, I'm packing up, I'm moving my entire life to Manila or Cebu. Surely the U.S. tax system just stays behind in America, right?
Well, the blunt truth is, nope, not at all. The IRS, they actually care about your passport, not your zip code. Because the United States tax system is based entirely on citizenship rather than your place of residency, your retirement income is always in their sights. So whether you're living in Massachusetts or Makati, if you hold U.S. citizenship, you are getting taxed on your worldwide income.
All right, let's dive into Section 1, the dual tax reality.
Okay, let's look at how these two systems clash. We just established that the U.S. taxes its citizens on worldwide income. But guess what? As a dual citizen who actually moves back and resides in the Philippines, you're considered a resident citizen by the Bureau of Internal Revenue, the BIR. And the rule for Philippine resident citizens? You guessed it, you are also taxed on your worldwide income. So we have a situation where both countries are legally claiming the right to tax your exact same global income stream.
To make this concrete, just picture two giant buckets in front of you. One is your U.S. bucket, holding things like your Social Security, your 401k, maybe some IRAs. The other is your Philippine bucket, and that holds your local bank accounts, maybe some local real estate income or local pensions. Because of this dual tax reality, both the IRS and the BIR are reaching right in and dipping their hands into both buckets. Your U.S. retirement accounts still have to follow U.S. distribution rules, but the Philippines might want a cut of that money too, and vice versa.
Which brings us to Section 2, the reporting trap, FBAR and FATCA.
I really want to sear this number into your memory: $10,000. If the combined total of all your Philippine accounts hits $10,000 at any single point during the calendar year, you absolutely must file a foreign bank account report, or an FBAR. And remember, that is an aggregate threshold. So if you have 3 separate Philippine bank accounts with $4,000 each, you just hit $12,000 total. Boom, you've triggered the FBAR requirement.
And you know, this FBAR net, it's cast incredibly wide. It catches pretty much everything. We're not just talking about your standard checking or savings account. It includes foreign investment accounts, foreign pensions, and here's a big surprise, even a Philippine life insurance policy if it happens to have a cash value. Honestly, this reporting requirement misses almost nothing.
Now, if your assets grow and you start holding a bit more wealth overseas, you are also going to trigger FATCA reporting with Form 8938, usually when your foreign assets exceed certain thresholds, like $200,000. And please keep this in mind. A key provision of the U.S.-Philippine Tax Treaty actually legally allows the two nations to exchange your financial data. The BIR and the IRS, they are actively talking to each other. Trying to hide assets is a fast track to massive fines, sometimes upwards of $10,000 per year just for noncompliance.
So, what if you're sitting there, hitting 60, getting ready to retire, and you're just realizing all of this? What if you've never filed an FBAR for that local Philippine account you've kept open for years? I'm sure panic might be setting in right about now, right? Take a deep breath. Don't panic. The good news here is the IRS streamlined foreign offshore procedures. This program lets you catch up completely penalty-free. You just have to file 3 years of delinquent tax returns, 6 years of delinquent FBARs, and, this is the crucial part, submit Form 14653. That form certifies that your conduct was non-willful. Basically, it means your mistake was a genuine, honest misunderstanding of the rules, not you actively trying to hide money overseas like some kind of James Bond villain. Okay, let's flip the script and look at your defense in Section 3, the shields, tax treaties and foreign tax credits. First up is an absolute game changer: the U.S.-Philippine Tax Treaty. This treaty is a lifesaver because it can significantly reduce the withholding taxes the Philippines takes on passive income. So, normally, a non-resident foreign corporation or individual might face a pretty steep 25% standard withholding tax on dividends. But thanks to this treaty, that rate plummets down to 15%. Taxes on interest and royalties also see significant reductions. Essentially, the treaty ensures these two countries negotiate who gets to tax what, which keeps a whole lot more money right in your pocket. Next up, we have the foreign tax credit, which you claim using IRS Form 1116. Let's say you pay Philippine income tax. Now, that operates on a progressive scale and can reach up to 35% for top earners. Well, you can use the foreign tax credit to essentially wipe out your U.S. tax bill dollar for dollar on that exact same chunk of income. Meaning, if you paid $10,000 in taxes to the Philippines, you get a $10,000 credit against your U.S. taxes. This is quite literally how you mathematically eliminate double taxation. Moving right along to our final strategy, Section 4, Retiring Smart at 60. Let's talk about actually getting your money. When you claim your U.S. Social Security, you don't need to stress over complicated international wire transfers. You can just use the Social Security Administration's direct deposit sign-up form, which is specifically designed for the Philippines. This allows your benefits to be safely direct deposited and automatically converted into Philippine pesos at your local bank, using the daily international exchange rate. It's secure, it's fast, and it entirely removes the headache of moving your money manually every month. Now, healthcare, that is the other massive piece of the retirement puzzle. Because Medicare generally will not cover routine care in the Philippines, the absolute smartest strategy here is actually pretty straightforward. First, you just pay out of pocket locally. Routine healthcare in the Philippines is incredibly affordable, often just between $100 and $400 a month. But whatever you do, keep your Medicare Part A and B active. If you drop Part B, you're going to face permanent penalties if you ever want it back. By keeping it active, you keep your ultimate safety net. You can always return to the U.S. for major complex procedures like cardiac surgery or cancer treatments, where Medicare will have you covered. All right, let's map out your year. Because juggling two complex systems means managing a whole lot of dates. Mark these on your calendar to keep both the IRS and the BIR happy. April 15th, as you probably know, is when any U.S. tax payment is due, and it also happens to be the standard Philippine annual return date. May 15th is the extended Philippine deadline, specifically for 2025 returns. June 15th is going to be your best friend. That's the automatic filing extension for U.S. expats. And finally, October 15th is your hard, absolutely final deadline for that super important FBAR filing. Thousands of dual citizens and expats successfully pull this off every single year. They navigate these two systems to pay absolutely zero in double taxes, all thanks to the foreign tax credit, tax treaties, and just really smart planning. It takes some organization, sure, but it's entirely doable. But remember, tax laws are literally shifting beneath our feet all the time. If that U.S.-Philippine treaty got renegotiated tomorrow, would your retirement strategy survive the shock? Stay informed and stay confident.
Hit subscribe for more wealth-building tips.